In today's episode, once again, we speak to the amazing Doug Howarth. Doug has unveiled a groundbreaking theory called hypernomics. This theory isn't just for economists, it's for anyone who wants to unlock the new possibilities in wealth building. In a nutshell, hypernomics challenges the traditional law of supply and demand by suggesting that the relationship between price and demand isn't what we've always assumed. Hence, today we're asking Doug why the law of supply and demand is only partly true. What other factors are important? Let's speak to him and find out. Welcome, welcome. This is Gull Khan, your money mindset expert. And once again, we have the amazing Doug Howarth. Welcome, Doug.
Gull, thank you so much for having me on. I really appreciate it. Love your show.
Thank you so much, Doug. We had such a fantastic conversation with you on Friday Feature. We had to have you back on Money Talkies. And once again, everybody's heard how wonderful and how amazing you are. But please, in your own words, tell everybody what it is that you do.
Well, what I do is I instruct people about and show people how to use this new phenomenon called hypernomics, which is a version of which is really multidimensional economics. And it shows people how they work out the value of a product on one side of their brain, and they work out the demand for the product on the other side of their brains. And these two things join and merge across a price barrier, and it shows them how to use this information that they already know to reassemble it to give them something that they haven't seen before, but turns out to be vital to their interests.
Wonderful. And this is what's going to be the topic for today's conversation. So
Okay.
we're talking about why the law of supply and demand is only partly true. And can you talk me through what you were talking to me just before we started rolling the camera? You were describing to me why that is the case. Why is the law of supply and demand only partly true? And what is it true for?
It's only partly true for what we would call single feature products, single feature commodities. That is to say, a commodity that's only got one element to it. So like pure gold, pure silver, a certain grade of iron ore. So if you were to go out and pull up a chart of iron ore by mines, they will give you the cost for iron ore by each mine. And there's some that are very inexpensive, they're always running. And then there's some that are more expensive. And then if you add a little bit of money on top of that for profit, that becomes the supply curve. There's an upward sloping supply curve for iron ore. And then there might be just one price for it. So that would intersect at this one price. But iron, crucially, goes into steel. Steel goes into airplanes. And there are, in the business aircraft market, for example, 93 business aircraft that are doing just fine that are not a single point equilibrium. There's 93 points of sustainable disequilibrium, which is to say that people are selling the product for more than it cost them. And that allows them to be viable. And so this recognizes that there's the demand for the planes on the one side. So the higher the cost of the plane, the fewer that are built. But if you're buying a plane, just like if you're buying a boat or a computer, you're willing to spend more for a plane that's got bigger capacity, it's a bigger tube, or a boat that's larger. And you're willing to pay more for a boat or a plane that goes faster. And it turns out there's a response for that we can describe mathematically. And that's what hypernomics does, is it figures out those responses and then describes them so that you can use them to your benefit.
So let me understand this correctly. What we've learned, and I've not studied economics at university level. I just know the basics and what I've understood from running multiple businesses. We're always taught that there's a supply and there's demand, and at some point, you have that curve coming up. Okay, so that's the supply and that's the demand, and you sort of base your pricing based on that. So if the demand is high, the price goes high. If the demand is low, the price goes low, and basically that's it, right? But you're telling me that that's true, partially true, because that can only be true for something like iron or basically commodities, oil, crude oil, and gold. When other factors come into the picture, which changes the value or perceived value, then we can no longer gauge on supply and demand. There's different dimensions to it which come into the picture, and they
Yes.
are equally important to gauge the price point, which is optimum now. It can no longer be, well, because we got 10 of these things, and they are and we have demand of 5, so we're oversupply. It could be the 10 that you have are rare and whatever else, and the demand can go up based on the perceived value. Am I understanding this correctly?
Yeah, that's actually very close. What we like to use is we have instead of having this long-winded discussion of what the law of supply and demand is. So if you pull up a textbook, you're going to get a paragraph on what that is.
Yes.
The law of value and demand, which is
Yeah.
what we use, is
Yeah.
much shorter. It's only got 4 clauses to it. It says the product features drive value.
Yes.
So for example, again, in a plane, how fast it goes, how big it is. Features determine price. So eventually these features are going to figure out what the price is. You might overprice it and then the market will bring it down. You might underprice it. You'll find you have to raise the price. Then price limits quantity sold. And then quantity sold is a feature. And so the whole thing, people say, Doug, it's circular. I said, yes, it's always been circular. It's always been interconnected. It's like a balancing act. It's basically the market accounting, that the value and demand occupy both, separate sides of the same problem. If you add more features people like to a product, people who can pay will pay, but at the same time, the amount being sold will
Will drop,
fall.
yeah.
If you were to make something cheaper, less expensive with fewer features that people still liked, the price would fall and then the quantity sold would go up. But they're on opposite sides of this price line that we have here in the middle of it.
So, I mean, I'm talking about, if I think about this in terms of coaching, which is another one of my businesses, where I'm familiar with the fact that if you put the price up for your coaching, that you may end up making more money, but the number of units sold or the number of spots sold always decreases, because the higher the price point, the smaller the pool of your buyers, right? And the smaller the price point, the higher the buyers. But it's that's a different factor. It's a different matter. I think most people believe, and I do, from my experience, believe that it's just as easy to sell 10,000 product than it is to sell 1,100 pound products. It's just as difficult, or probably sometimes easier to sell that one product of 10,000 than it is to sell the 1,000 for 100 bucks, right?
Sure.
But you're saying there's an added to it is, no, you haven't. Explain this to me. What about the perceived value? Because the features give value, but there's such thing as perceived value. So in certain circumstances, you perceive the value of, for example, Apple. They have an iPhone and the features are X, Y, and Z. And Samsung comes out with a phone with identical features. But I mean, now it's probably not a misnomer, but say about 5 years ago when Apple was dominating, they would have, I think at that time, this is actually probably true, because Samsung did have a better camera compared to the iPhone.
Right.
Yet, iPhone price was higher and its perceived
Yes.
value was higher, not necessarily because it was a better product. How does that come into play? So the perception of value, not actual true value.
Well, what happens here is the line between perception and actuality starts to blur. And what happens is, if people believe that it's worth more, then the value comes from buyers, from people. And if you believe it's worth more, that creates its value. So one of the reasons that Apple would command more for a phone that didn't have as many features as say a competitor is that in the Apple community, people like the ease with which the Apple products merge with other products.
Yes.
So for example, I have a Samsung, but my wife's got Apple, and she likes it. If you have an Apple product and say an email pops up, it pops up to your phone, to your iPad, so you can easily find pictures going back and forth, and it becomes more cumbersome with other products. And so the ease with which Apple's data flows between all the platforms helps describe its value to the users. And plus, they try to make the products look sleeker. So there's a value to the appearance of a product. We did a project one time for a company that was building an airplane, because, we came out of aerospace. And so we looked at the speed and the capacity and all that stuff that we mentioned before. And then they said to us, he said, we think our plane is prettier than the average plane, which you can imagine an iPhone looks prettier to the average user than
Yeah.
a Samsung. And so could you quantify that? And so what we did is we sent out pictures of all the planes in this group that people were buying. And it turned out that after you solve for everything else, the speed, the range, and everything like that, that the physical appeal of the plane had a value to it. And not only did it have a value to it, that the plane that our client was trying to sell was prettier than the average plane, meaning that they were going to get more value because they had spent more time making the plane attractive to the public. And so there are things out there that may not be easily visible at the start, but when you start to think about it, this case, our client asked us to consider a feature we hadn't considered before. You might find that you're able to describe the problem more tightly when you start to consider all the features that are out there. So what we're trying to do is to describe the value of a product and try to narrow the error that we have around our description. And that's part of what we do here, is try to keep figuring out features that describe what that particular product is. If it's anything from a phone to a stock to a car that you might drive, you can do this analysis for virtually everything.
How do you factor in things such as FOMO? Because I'll give you another example. Stocks reminding me of Navita. So I became aware of it, I think, beginning of this year, and I already thought it was overpriced. So big mistake on my part. I thought it was overpriced then. I thought, I'll wait for the pullback. The pullback never happened, and I missed the opportunity. But even at the moment, when we look at it, there's high demand, and that's coming from FOMO, I think, a lot of the times, because all the data and everything else is indicating that it's overpriced and so forth. So actually, my calculations did show I still think it's overpriced, even after the stock splitting. But how does that come into it? So how do we factor in the FOMO? And that's one of the features that I think people who sell a lot, especially limited items such as Nike, and they have these limited edition trainers or whatever else, for makeup. It works in all industries. Is limited edition, especially high-end brands. They're able to create this FOMO, fear of missing out.
Right.
And that's I suppose as another form of value, another dimension to it. Is that how you see it?
Yeah, I remember when I was saying that the law of value demand said features drive value, value determines price, price limits quantity sold is a feature.
Yeah.
When you come back and you say that we're only going to have, like with the shoes, we're only going to sell 10,000. What that does is it knocks the available amount down, meaning that the price is going to go up. And so by telling people that you're only going to sell so many, you're actually forcing the price to go up. Now, when it comes to NVIDIA, by the way, I'm with you. I thought it was overpriced before. I think it's overpriced now.
Definitely.
One of the reasons I got into this is that here in the United States, I don't know if it happened out there in the UK, but in the 80s, there was a big run up in prices in housing here. So I got hung up on that and bought a house in 89. And 12 years later, I sold it for a $79 profit because the market basically crashed and took, almost close to a decade to recover.
We had that in 2008. So
yeah,
markets, especially certain properties here, is still basically recovering. So yeah.
Right. And so I think what we've seen happen in the market is that money's moving out of the other stocks and going towards NVIDIA.
Yeah, 100%. 100%. Everyone's jumping on the bandwagon at the moment. Everybody is.
It's a bandwagon thing. And back to your point, we find it to be overpriced too. The PE ratio is
exactly,
close
the
to
PE
80
ratio
right
is really, really high.
now.
And
Yeah,
I was sitting there scratching my head. I do want to jump on the bandwagon, and I don't do what everybody else is. What everyone's doing, I usually do the opposite. So that's my philosophy in life.
Right.
And so I feel like, okay, I missed out, but I'll still follow that was correct procedure even back then, especially now. But it's driving the price up really, really high.
It is. Now, speaking of the stocks, we put together a test fund out of my own money. And by the way, I have to clarification, nobody can get into this fund. I have to make sure that our Securities and Exchange Commission knows that I'm not touting what we're doing.
You're not promoting, of course, yes.
But in February 2020, we put together what we call the Hypernomics Fund, and
Mm,
we indexed it to 1 at that time, and we indexed it against the S&P 500 and Berkshire Hathaway.
mm,
And after 50 months, we went from 1 to 2, that was the time to double. And
mm,
our internal rate of return was a little over 15%. And in that time, we were 1.9 times, doing 1.9 times as well as the S&P 500
mm.
and 1.2 times as well as Berkshire Hathaway with Mr. Warren Buffett. And the chance of that coming about due to chance was less than 1 in 1 quadrillion. So these techniques applied to the stock market, they work pretty well. Now we didn't account for FOMO. It'd be interesting to apply FOMO in there. That's one thing that we haven't done before. But FOMO is this kind of cyclical thing too.
Yep, 100%.
And it when we say
And it's
irrational
a, it
exuberance,
and it's a rollerball as well. It's a snowball effect.
yeah,
It gets bigger and bigger and bigger until there's a crash.
yeah, right. I mean, back in Holland I think in the 1600s, people were buying tulips
Oh yes,
for the,
I remember
you
that. I
know,
remember
the,
studying
yeah,
that.
right. The tulips went up to, I mean, people were paying the equivalent of $1,000 for a bulb.
Yes, they were.
Then the
They
market
were.
just fell
Yeah.
to pieces. And
Yeah.
so I'm not saying Nvidia is going to crash. I mean, people like the idea of AI, and we do too. But at our company, we like to say we're a little bit less A and a little more I.
Mm.
There's a little bit less artificial intelligence, a little more I, meaning the
Intelligence.
intelligence,
Yeah.
because we actually separate all these forces into these factors that you can examine mathematically. You can actually see visuals on all this stuff. You can actually pull apart the forces that are at work.
Hmm.
And so that's what we try to do, is to pull apart those forces.
So, okay, so if we sort of try to sum this up now, my understanding of is it hypernomics? Is that the phrase you use?
Hypernomics.
Hypernomics,
Hypernomics.
hypernomics.
Yes.
So basically you take, rather than just looking at something as this, that we have we have this number, this is the amount of quantity, we've got 5 of these, and we need to work out 5 clients, or whether we have the demand for 5 of them. Rather than keeping it in a very simple format, we now look at those. Okay, we've got 5 items, these are the features, what is their value added to it, and looking at it in a very multi-dimensional way, which I think you were right, because you said we're already doing, because we do this anyway. So when I go,
Yes.
when we create a new, so I'm thinking about when we, because I have a manufacturing firm, and when we create, and we're subcontractors, we don't have an end product firm, we're subcontractors. So when we are creating quotes and sending them out to our clients about what we can do, what part we can make for them, our USB is the lead time, the quality, the fact that we're UK based,
Right.
and etc., and the processes we hold up to. And so those are all part of our perceived value, because there's no way we can compete with
Right.
China, right?
Exactly.
So our values, those things are added. So we already are thinking about this. We are already taking into
Yes.
account.
Exactly.
Just never really put it into the terms that you just expressed. So yeah, it makes complete sense to me.
Yeah, your client's already doing that, and that's the reason you're getting the work. You're already offering them those features. Like if you
Yes.
have a lead time that's 4 weeks, and somebody from China's got a lead time of 8 weeks,
Yeah.
that adds to the value that you have, and that's part of why you can sustain the prices that you have.
Wonderful, wonderful. So
Right.
can you give me a quick summary again of, by answering the question, why the law of supply and demand is only partially true?
The law of supply and demand applies pretty well to commodities, which is to say a thing that's got a single feature to it. So like pure gold, pure platinum, crude oil. We like to use iron ore. So
Mm,
iron ore, the iron ore market has a series of mines that actually support it. And the mines are very inexpensive down at the bottom. They get progressively more expensive. And as the demand for the iron ore goes up, the mines that have become progressively more expensive get pulled online. And there becomes one point for this market going up and down for the raw iron ore. But iron is a commodity, and iron gets made into steel. Steel goes into cars, goes into phones, and goes into airplanes. And airplanes, for example, have a speed, a range, a capacity to them, and all those things figure into the value. And so that you can't use a single feature methodology on a product that's got multiple features. And so hyper Hyper means existing in more than three dimensions.
Mm.
And nomics comes from nonomy, meaning a field of study. So hypernomics is a field of study that exists in more than three dimensions. It starts with four and goes from there. And while it sounds complicated, it's just basically merging a bunch of stuff that you already know and putting it into a view that you haven't seen before, but becomes crucial to your understanding so that you can go forward and do good things in the world.
I think that knowledge is invaluable for scaling up your business as well. So once you've hit break even, you know how to sell a product or sell a service.
Right.
Using that information becomes invaluable when you start to scale up, because that is what's the missing link or missing
Right.
piece when you are trying to scale up. Because when you try to scale up, things go haywire, and because you invariably have missed one of those valuable elements, be it the cost of sale, the feature. You lose a feature because when you're trying to sell more of those products, or something goes amiss when you try to scale up. And I think that's why it's important when you are trying to scale up in a profitable way and
Right.
successfully, you need to take into account all the different factors you just described. So, hey, that's absolutely phenomenal. I learned so much today. So thank you so much, Doug. It's been brilliant talking
Thank
to you.
you.
So tell us, Doug, how can we connect with you? Where can we find you on the internet?
Okay, well, my brand new book called Hypernomics, Using Hidden Dimensions to Solve Unseen Problems, is available for sale from the Wiley site. That's my publisher. Also on Barnes & Noble, and you can find it on Amazon. And I have my own personal website called doughowarth.com. You can write me there. Or you can go to the company website, which is hypernomics.com. That's hypernomics.com. And you can write us at info@hypernomics.com. Lots of my little blogs or posts that go onto LinkedIn, and I'm on LinkedIn. You can find me at Doug Howarth. The blogs from that internet, Instagram kind of social media posts go onto our company website, and you can find a bunch of different vignettes that show how hypernomics can affect you in your daily life.
Wonderful. Now, if you're listening to us on the podcast, the links for Doug will be in the show notes. And if you're watching on YouTube, down below in the description section, we'll have the links for Doug too. Check him out and see how he can help you build a better business. Thank you so much, Doug, for being such an amazing guest today. And we've had a fantastic time talking, and thank you so much.
Gull, thank you so much. I really appreciate being on your show. Thank you.
Thank you. And thank you for listening to me and Doug today on Money Talkies. I will be back with another amazing guest, finding out how you and I can build a better business. Until the next time we meet, this is Gull signing off. Take care and bye for now.